Today we have a very, very interesting discussion on iSAFE notes, which is brought to us by Yagnesh Sanghrajka. That's a tongue twister, and so he just explained to me how to pronounce his second name. To give you a brief, Yagnesh is a CA by profession. He has had an illustrious career. He's currently the founder and CFO of 100X.VC. He's an astute expert in finance, M&A strategy, and investor relations. He has had his corporate experience with Hinduja Global Solutions, Phoenix Mills, MT Educare, which was bought over by SL Group, which we all know as Mahesh Tutorials. But most interestingly, he has also been the head of ops for India for Bessemer Venture Partners. Today's session is going to be about how 100X.VC, with the help of Yagnesh, got iSAFE notes to India. There's been a lot of confusion, commotion in terms of, term sheets and agreements between founders and investors. It's a long drawn process. In the US, the time from VC agreeing or the founders and VCs agreeing to terms and conditions to money in the bank is not more than 4 to 6 weeks. So with Sanjay Mehta and Yagnesh, they wanted to bring that culture here. And they were the first ones to introduce iSAFE notes in India. And they've kind of gone through ratifying it for Indian conditions and everything. And which is why we thought this is a very interesting session. So introducing Yagnesh, who's going to explain to us, I've requested Yagnesh to demystify iSAFE notes. So today, it will not be Yagnesh, founder and CFO. It will be Professor Yagnesh teaching BCom finance students. Over to you, Yagnesh.
Well, thanks, Naveen. Thanks for that small but illustrious kind of introduction. We are all trying to learn things as we go along. But what we find interesting is that whenever you come across an innovation, all these startups, I'm going to use a little bit of startup language because we have a lot of founders in the audience as well as investors. So I'm going to make it very, as far as possible, friendly and demystified as you want me to. So whenever we come across something new, we try to imbibe, right? In our own life, we try to learn things, incorporate that in our life, and then try to adopt it. For with iSAFEs, it's been the same story for us. Me and Sanjay go a long way back. And, after my CFO stint, I was advising startups on fundraising. And here, Sanjay came with this whole idea. He was already investing in the US. So I'll jump into the presentation, if you will.
Yagnesh, can I just give a few announcements to the participants so that will help you?
Sure.
So what Yagnesh has requested is hold on to your questions till say maybe about 45 minutes to 50 minutes from now, because most of your questions are going to be answered in the way he has thought through the presentation. Otherwise, what's going to happen is you'll start questioning now, and by the time I pick up the Q&A post 45 minutes or 50 minutes, your questions will become irrelevant because they would have been answered in the progression of the slides. So just hold on to them. I'll give you a cue maybe in about 45 minutes to when you can start posting. Unless there are some genuine issues of you don't understand an acronym or he has made some reference to something which a lot of people have lost on that, do ping me on that or ping us on that. I'll kind of stop him and ask him. Otherwise, he'll go on with his presentation for about 45 minutes. He's also got a few sample, iSAFE note and working on how it really works, which he'll also present. And then we'll open it up for Q&A later towards the end, and he'll answer all the questions. And Yagnesh, to start off with, if I may request, could you start off with about 5-7 minutes on what's happening in the startup world, what's happening in the funding world? Are people writing checks? What are you seeing in terms of not only just iSAFE notes, terms and agreements, what's happening to term sheets right
now? Naveen, thanks for that. And I'll spend the first 2-3 minutes to kind of just tell you what's been happening, what are we doing. When we talk to people, what are they saying? What are they sharing with us? Founders, investors alike. So, some of you may be seeing a lot of sessions by Sanjay with, VCs, investors, and so do we, with experts. We try to understand sectors, which industries are kind of, picking up pace, which ones are the ones affected. So I'm not going to go into too much detail, boring you with what are sexy sectors and what are not. I'll stick to rather something which is close to our thesis, is that we are finding some aggressive founders really coming to us. And I'll talk a little bit about more on our own thesis. So when we invest, we obviously place the highest importance to founders, and we characterize them. We get into something which is an unwritten code with founders. And you feel that when you invest and when you start evaluating companies, you can feel that passion coming through. And some of it is not articulated in these pitch decks that normally founders present. But the art of the investor to kind of do these deals is to cut across the noise and try to get into meaningful content and meaningful platforms that companies are building. So we're seeing a lot of that now coming through, some very radical ideas, dynamic things coming across. Of course, with our own portfolio companies, I'll talk a little bit about that, have been facing issues, but thankfully no mortality so far in our portfolio, because we've really worked with them to see to it that they extend their runway one way or the other. Survival is the key right now for most startups, and to know how to survive is very important. Growth can happen later. Right now, these are times where you actually try to survive. Um, and while you are surviving, try to think about when things will come to normal. What are those couple of things that will trigger you to that high trajectory of growth? So that's what we've been trying to advise founders. That's what we've been hearing with investors. Most investors are right now not really cutting checks. They are signing term sheets. They are committing, but they're not investing right now because of all obviously the situation that is all around us, right? They are all interested in looking at deals. We are all looking at deals, but the process has become slightly slow. So my advice to founders is be patient. You will get your turn. You will be allowed to present if your idea is good. Keep the tenacity on, like you do, like you go for your customers, how badly you want that customer. Same is with investors. So, don't reduce your tenacity or don't have a different approach. It's the same approach, guys. Uh, Try to get to the investors one way or the other. And one day, they will listen to you and this will happen. So it's all about, these matter of times. People's sentiments change very fast, surprisingly. And I've seen that, believe me, in my 30 years of career. So, having just this 5 minutes, let's just quickly jump on to the presentation and try to make this fun and enjoyable, guys. I've tried to address as many things as possible, but let's see how it goes, and I'll address all your questions before we end the session. So I'm going to share my screen now. Yeah. So is my presentation visible to all, right? So, okay. So, here is this. So as Naveen said, let me jump into history of safe notes, right? And these are all, I mean, some people that are there here may have Googled it, seen it, heard about it. This was actually introduced by Y Combinator back in 2013, one of the biggest, accelerators in the world. And they have funded so far 1,500 odd companies using iSAFE, using safe notes. And, there are some very large stories that have come out after, YC kind of invested in them. These are names that you already know, right? Airbnb, Dropbox, Reddit, Meesho. These are just, I mean, they have like tons of companies with billion-dollar valuations that have all started using safe notes. And that is what I thought was very relevant for you guys to know, because that's the kind of, the history, the origin where these large companies were made. Also, some of these investors that you see here, Axel, Sound Ventures, Khosla Ventures, Sequoia, all of these guys have ended up investing in companies which were funded by YC. So YC also had the model of safe notes where, they came in right up with the bootstrap founders, supported them, and then they became like a discovery platform. And that's what, we thought between me and Sanjay when we're discussing this, when we started 100X.VC, we said, let's bring this to India. This is what basically India needs right now. So we kind of launched the fund in June 2019. It's a SEBI registered AIF, and we introduced iSAFE. We spent a lot of time. In fact, I spent a lot of time with lawyers, and we got this document ready and this all complied with Indian laws and customized for the Indian ecosystem. And we started this whole thing, and then we started funding startups, and we had a good target of like funding almost about 30-40 companies. We ended up investing in 20 in 2019, and we do this with classes, right? The batches. We do these classes of 20 companies, 10 companies each, and take them, fund them, work with them closely. The whole thesis here is to kind of become a discovery platform for these companies and for investors to kind of discover these companies. You will be glad to know that our experience, it was like we were like a startup, right? So we didn't know what will happen post iSafe, and how will this be taken, subsequent funding hoga ki nahi hoga. These startups, they are new to it, so a lot of unknowns, just like any other startup that you guys must be starting, right? But we were very happy to note that some of these startups who are there from the 20, almost half of them by now have also got funding through Safe Notes, through iSafe, and some of them even got a couple of $100,000 by now. So this is really kind of this whole journey, especially me interacting with angel investors, angel networks, VCs, kind of brought this whole concept saying this is what it is, and they found it very interesting. And we'll like unravel this in the future slides. So we try to create a lot of awareness. I've been doing a lot of webinars, seminars. Sanjay has been talking about it in forums. TiE has been really helpful. We've created at least a couple of sessions here, and this masterclass, hence, to kind of create this whole awareness around iSafe. And so, I feel it's no more fear of the unknown, and more of that will happen as we go along. So coming to this, the problem statement, like, every startup pitch deck has to have this problem statement, right? So I'm using this to use the same analogy of making it, why iSafe. So, some of you may have attended the session that was there with Vipul Mehta. He tried to decode term sheets, founder agreements and stuff. And you actually came across a lot of terms that probably were new to you. And you must be trying to think, yaar, wo wapas se padhna padega pura, it's like a master class. So let's go back, read those terms again. What do they mean? How do I talk to investors when somebody's interested to invest? We'll simplify all that, and I'll try to further simplify in my presentation. And Vipul is an expert on this, and he's a good friend as well. So we keep discussing about relevance of iSafe, and he's been also a great advocate of that as well. So coming to this, why do we need iSafe? So typical problem, right? Everybody knows when they start with the good idea, the great big idea or the eureka moment, they feel, my company has to be worth few hundred crores going down the line. But if not, few crores even on day one. Well, and sadly so, when they start interacting with investors, 9 out of 10 guys typically are disappointed when investors tell them otherwise. So what typically happens is there's a whole big mismatch out there that happens on valuations. I might feel as a founder that, my company is worth 15-20 crores on day one. The investor says, it's an idea on paper. So how can I value you if you've not even started doing something? Or maybe, done a couple of use cases. Why should I value you so much? So there's always no meeting of minds that happen here. And hence, that's the problem. That is the biggest problem at the core of it. Another thing, execution costs, even if, let's say, you manage to convince the investor, okay, fine, my idea is good, let's go ahead. This is some kind of indicative valuation we all agree to, and the check size, let's sign the agreement. And that's where really those tragic moments and those harrowing times start, right? People hardly know what's written in the SHA. It's a fat 50, 60, 80 page document. Most of the founders really don't know what's happening there, and they have to decode it. And they obviously use lawyers to do that, consultants to do that. And that's a very, very difficult time for founders because they are not made out for this. They are not cut out for this. And anything that you sign without knowing what kind of repercussions it can have is unimaginable. Your life is at stake, right? Your career is at stake. So signing something wrong without knowing can be the worst thing to happen. So that's another anxiety that happens. To top it all, it takes tremendous amount of time to sign these documents, get those paperwork done, have proofreading done, again going back and forth on the document, and it really takes 3 to 4 months. And Naveen and everyone knows this very much, and most of you guys, that from the time somebody agrees to invest in you, and by the time the funds hit your bank account, it almost takes 3 to 4 months. That's another pain point. So really, nothing founder friendly really existed in the system so far. Those are the kind of problems that we are talking about, right? So what's iSAFE and what's the advantages? Why are we talking about it? iSAFE simply stands for India Simple Agreement for Future Equity. And spend 1 second more on seeing what it is about and full form of it, and you'll know what is the solution here we are talking about. And I'll decode it further. So it's that founder-friendly solution that we are all looking for, the industry is looking for, the startup ecosystem is looking for at early stage. So please note this very clearly. This is a very seed stage, early stage kind of solution. True to its name, India Simple Agreement for Future Equity is that document which kind of addresses this problem of valuation. You don't need to discuss valuations now. You can keep it for the future. Right now, you could take the check with some key terms agreed, and the conversion can happen later. So the dilution by the founder can take later. And those of you who attended Vipul's session will understand what that dilution means. There's no key metrics available, right? You're just kind of couple of POCs done, some indication of the market potential, some knowledge about the opportunity is there between the investors and the founders. And hence there are no key metrics available by which you could value your company. So iSAFE then becomes your most trusted solution. More importantly, it's a simple 5-page document. It's a cookie cutter kind of a template which people can use, and I'll show you that in a while. No need of expensive lawyers to kind of decode you. You can read it yourself, pretty much explained. If not, you can go to the YC site. They have explained it very well. Costs are reduced. You don't really have to pay lawyers so much and spend time on decodifying the document. Time taken to conclude can be as soon as 2 to 3 weeks. By the time you like a company, the investor and founder sit across and say, fine, this is the check amount you need, and this is something that we can both agree to. No need to really put a number to it, and that's what you do. You put some indicative kind of stuff, and we'll deal more with types of iSAFE in a bit. Time taken to conclude transaction is hardly 2 to 3 weeks, and we've seen that. We've done, in my last class one, we really closed one transaction in 3 days time. Signing the iSAFE, money in the bank, flat 3 to 4 days. So that's what this can do to you. And imagine, startups is all about speed of money, speed of the transaction, speed of the founder to get the solution out in the market. And this changes a lot of things for them and for the investors subsequently, right? Founder can then focus on their business, not worry about documentation, complex processes, and hence, this is customized for laws and it's legit. So kind of solution to all. It's like a panacea of sorts. Let's talk something more about, what more facts are known about iSAFE and can be known. So again, you heard about a presentation already earlier. Vipul must have discussed, and you can read it out. It's open, law. There are 3-4 types of documents that company law prevails, and it kind of enlists certain instruments like an equity share, a preference share, a convertible debt. iSAFE takes legal shape as compulsory convertible preference shares, which is in short CCPS. Stands for CCPS. It's that convertible note. It's neither equity because you're not getting into the cap table. You're not issuing equity shares right away. You're issuing CCPS for a future conversion. And not debt, right? It's not a compulsorily convertible debt. So it's not a CCD, which kind of a startup issues at the time of investment. So CCPS today that you see in the market are all with fixed valuations, right? This is a CCPS with future valuations. That's the difference. This is a way to understand what difference is it, and I'll come to more in terms of differences. And of course, these are reflected in your financial statements, as your auditor will tell you, under shareholder funds. So this is not a loan. This is not a borrowing. This sits into your equity share capital, right? So that's typically the way the legally shape works. How do you really execute? How does one go about it? Assuming you have an agreement with investors. So typically, there's a ready draft, as I said, and we've kept it open source, and I'll show you the draft as well. Discuss key clauses, seek investor consent up in the agreement. Since this is obviously a legally a document of CCPS, you might have to do some ROC filings once your company is made. And I'm assuming all of you guys by now know that your company has to be registered under company law as a private company. Ideally, you should be registered with DIPP, right? The Startup India program, which kind of helps you with a few relaxations that you will get as registered also as MSME. Now with new laws coming with MSME, you can easily go register online with MSME. So all of these things in place, you will have to probably increase your authorized capital by a small amount just to accommodate the increase in preference share capital and stuff. File a challan in ROC, fees are to be paid and etc. before you sign the agreement. Preferably, you will need a company secretary or a CA who does secretarial work as well for you to just help you with execution, not with document itself, but with execution. So this happens at a very minimal cost. And some of you might want to know, this will be relevant. The whole CCPS, the iSAFE agreement execution, along with fees, sometimes only takes hardly 20 to 25,000, as compared to a whole exercise by the lawyer, decoding your SHA fees, and then you pay your CACS the fees. It goes up to 75,000 to a lakh. This can be brought down as low as that. So that's what I'm talking about in terms of the solution, so far as the reduced cost is concerned. On the signing of the agreement, you can transfer the funds into a separate account which the company can open, and then your company secretary can allot preference shares. Best part is that you can sign multiple iSAFE agreements with different set of investors. In SHA, typically what happens, all the investors have to come on a platform, right? Agree to all those rights, those difficult, rights and obligations of the investor, founders. They all have to come on one page and then sign it up, right? It's a tedious, harrowing experience. Here, multiple iSAFE agreements can be signed with different set of investors, right? So that's the convenience bit here. So you understood the benefits, right? Why can a founder just sign an iSAFE with an investor and just get on with life? So key features here, just kind of summarize and halt here in between to say that safe notes basically allow for high resolution fundraising. It is a high resolution fundraising document that you've seen, right? It addresses a lot of things instead of breaking it up and making it more complex. It resolves a lot of issues straight away at one point, and a flexible one document security as against multiple set of papers that in other solutions you will find. So these are the two key features here. Okay, so we've talked a lot about what has founders got to benefit from it, and it's a win-win in our opinion. But how is it a win-win? What's in it for investors? Some of the investors here sitting are wondering, इसमें मेरा क्या फायदा है? What is in it for me? Why should I, not fight for the valuation? Why should I not get it pinned down so that I can know what my stake is? Here's a little bit of decodifying that as an investor. So benefits for investors, very important here. Since you are converting your preference shares to equity at a later date, there is no dilution that you will undergo till the fixed priced post money cap table is drawn. Now some of it gets technical, but understand that while the founder is benefited by early stage money, fast resolution closure of the document and the funds, you as investors will not dilute, because the safe note provides for no dilution till there is a price round happening later. And that's when, folks, the discovery of price of the startup happens. So this resolves the whole problem of valuations having not to be fixed while iSAFE is signed. It can get later when the company uses funds, reaches a particular milestone, which is good enough for an investor to value the company decently and not really cheaply value the startup just because there's nothing right now that can be seen, right? So this is what it does. By the time an investor looks at it, a professional investor or an institutional investor, they will see a lot of progress in the company, right? And they can value the company at that stage and then do a price round where you could have all the stuff which is, the SHL led round and all of that. That's when the iSafe investor gets converted. So you don't really get dilution done. I'll explain that more by way of an Excel sheet. I'll stop here and then come back to the presentation because did ask me that, Yagnesh, please explain to our audience how does this really work. So just to get your attention a bit, and founders also should see this. So it's a long Excel sheet, but just be with me on that right from your from the left hand side to the right hand side. Typically when founders start, they start with their own equity, right? Which is you guys can see the screen, right? It is 10,000 shares uh, equity. Rahul, is this visible? Just to make sure.
Yeah, it's visible. Just one request, if you can shut your video for some time, it's lagging a bit. So
Okay, fair enough. So I'll just do that.
you
All
stop.
right. So yeah, I have done that. And going back to the sharing of my screen.
Yeah.
Yeah, is this better now, Rahul?
Yes, yes, yes.
All right, guys. So let's spend 2 minutes, 5 minutes on this Excel sheet because this is what really decodes the whole calculation and everything. So founders start with, let's say, 10,000 shares. 10 रुपए का share है. 1 lakh is your capital. That's what typically all companies do, right? Then comes, let's say, 100X or an angel investor, which kind of invests through an iSafe. So the way we do is a simple, let's say, if we were investing 25 lakhs, I would basically put in 25 lakhs as the first seed investor, or you could put in that. And it's a simple straight 7% stake. You just don't convert into the cap table. You just issue them at face value of preference shares, which is 2,50,000. You move on. There's another round of angel investor waiting, right? Because now you've used these 25 lakhs, you reached a particular milestone. And as I said, the sequel investor also is looking at iSafe, for example, right? You've still not reached the place where an institutional investor or a VC is looking at you, right? You're still too small for that. Then you go on to the angel investor and say, look, I want some more money to kind of grow the company and be where I need to be. So please give me 1.5 crores. And let's say between them, they, at this point of time, they do not agree for a valuation, but there's a cap to the valuation. Let's say between the parties, it's agreed that we agree for a 15 crore cap. Okay, because that's what your company is not worth more than. So I'll put a cap to it. I'll invest 1.5 crores. It can be one or multiple angel investors, right? And the dilution there should be about 10%, right? If you really calculate 1.5 crores on 15 crores post money, that comes to a 10% dilution. And you fund it, sign the iSafe, and kind of move on. Then comes your VC, right? When a VC comes in after a year, 6 months, 9 months, whenever that is, and let's say the company is going to be diluted for 20% for a 5 crore check. Let's say the company's post money becomes 25 crores, a pre money is 20 crores. That's when, let's say, an SHA is signed and everybody's stake gets finalized. Now here's what happens. So give attention to the last table. The way the conversion happens is, let's say 100X invested for 7%. So we get our 7% right here at this stage. We don't get diluted here as well as here. Now the angel investor, since he had come second in, he doesn't get diluted by the VC who is investing 20%. Because remember, if this 10% was issued in day one without iSafe, his stake would now be 8%, which is 20% less than 10%, right? So that's 8%, which then would have got the angel investor valued his stake at only 2 crores. With iSAFE, he still gets to keep that 10%. And that is post money, as I said, in the slide. And that 10% is now worth, the company is now worth 25 crores post VC money. And that 10% of that is 2.5 crores, folks. So imagine the benefit to the investor who is coming in with that 1.5 crore check is now worth 2.5 instead of a 2 crore check, correct? That's exactly what the benefit is all about. I hope that was pretty clear. I'll kind of jump back to the presentation because I thought this was important for investors as well as founders to kind of understand what do you mean by no dilution. You can negotiate a discount. Like I said in the example, you could do a cap or you could do a discount to the next round. You could do a 20%, 30% discount, whatever that may be between you and the investor to the next round. And I'll show you that in the types of investors, in the types of iSAFE that we'll discuss. Speed wins, right? Every time. So you can beat other angels and sometimes more importantly, VCs. So we've seen some deals happening in our own class one where some of the angels were fast and nimble and they got into the company fast enough and then the valuation just jumped before the VCs came in. So, that is what really happens. The speed that iSAFE provides gets you in the right company by quickly closing the deal. So you as investor typically benefits if you close the deal with your startup soon enough. Founders also, we've seen with our own 20 founders, we've seen and more also those who have been giving us feedback, they feel more comfortable dealing with angel investors or investors who are willing to invest through iSAFE. So that's the benefit, folks, for you guys. Now let's jump in a little bit about what are the types of iSAFE that we have. There are different types, and I told you right earlier that we've kind of made it open source. You can see it on our website, but I'll just kind of take you through in the next 10 minutes on what are the different types of iSAFE. There are 5 different types. The one that I just showed you in the Excel kind of gives a fixed conversion at a future date. So you don't really value the company. So for the example, I had said 25 lakhs for 7%. That does not mean, folks, that the company is getting valued at 3.56 crores, right? It does not mean that. It means that I'm giving you 25 lakhs. You are promising me a 7% stake later, but not now. When your company is worth something, and in this case, you found out, right? The company is worth 25 crores down the line. And that is when you give me 7%. Till then, my CCPS is just lying there. 250,000 CCPS at 10 rupees is just lying there at par. There is nothing that I can really do about it. And that's the benefit that we are talking about for the founders and the investors alike. And that's the risk you take, right? The earlier stage you enter, the higher the risk that the investor takes. There's a fixed conversion at a future date. Again, valuation caps and no discount is an example we just saw in the Excel. There was no discount, but there was a valuation cap. The third type is where you have a discount, but no valuation cap. The fourth can have both. You can also have a valuation cap, a floor, and a discount. The fifth is, you probably sign a short iSAFE with the most favored nation clause, which says I will have the best of clauses or terms that will be given to subsequent investors. It cannot be without cap, it can be without discount, but it can be with a clause which says whatever benefits you give to subsequent investors, I will enjoy that benefit also. And that's perfectly fine too. And let's just jump in one. I mean, I'll just deal with this with an example too. I mean, I already showed that example actually in Excel, but let's take it again for 2 minutes so that things are clear. Remember, folks, the better it is for founder, the higher the valuation cap, the better it is for the founder, because obviously he will in future dilute less. So I've given 2 examples, and this presentation will be shared later. So no need to really try to read across all the text. I've tried to keep it to the minimum, but this is the example where in one example you convert 2 crores at a cap of 20, and then the conversion happens at a higher than the valuation cap. In that case, the investor will obviously get 10%, like in the example we saw. The option 2 is where, let's say you invest 2 crores at a cap of 20 crores. and the next pricing round is not happening at 20 for whatever reason, the company went downhill, the product didn't find market fit or whatever, the valuation cap came down for the next round or for the VC round. In that case too, you will calculate the lower of the two, the lower of the valuation and the cap, which is in this case 10 crores, let's say, you end up getting 20% rather than 10% earlier. So the investor will have to be compensated for that lowering of the valuation. And this is in some sense an anti-dilution clause, you might say, which kind of is at work, right? So the investor does not lose just because he signed up for a cap of 20 and there was no floor, right? Remember, so if there's no floor, this can go up to 20% as well. The second type is, as I said, straight 20%, 30%, whatever discount you negotiate, and that is a discount will be applied on the pricing round. And that's how the conversion to equity will happen here. The rate of discount normally depends upon the timing of the iSAFE round and how quickly, founder is expecting to close the pricing round. He can say, I'm closing it in like 10 days, 15 days, a month. And after that, this rate of discount will not be there. And you can have a mix of both, you can have valuation cap as well as discount. So, that's typically a mixed bag where you use both the stuff. And then, the MFN clause, which I just said, which kind of gives the investor the best of the worlds and for the future. But then one thing uncertain is you don't know what the next investor is going to get. So this is not a very typically usually used iSAFE, because it doesn't really put any numbers or anything fixed out there. So as I said, this is open source. They're all documents which you can find on our website. I'll quickly kind of scan through, guys, the document to show you how the contract looks like. And we'll just kind of quickly go through that. And it's available on the website, guys. So let me just make this bigger. And so, this is how typically a post-money cap document looks like. Right? You put the company name, you put the valuation cap, which is there in yellow, details of the investor, details of the company. Basically, the document is only 3 pages. It's the definitions, which are 2 more pages, which are there. There are clauses which, deals with a merger event of the company or a company, the equity financing round. The equity financing round is the one that I keep talking about as priced round. That is the one that it talks about what kind of conversion shares the company's investor will get on the post-money investment by the pricing investor, the guy who is doing SHA, the VC who is investing in you with the valuation, right? So again, termination clauses, liquidation priority, I think that's very simple. The fact that you are giving preference shares means that there is liquidation priority to the investor before the founder. Founder always comes last when it comes to monetization of the startup, or getting money on selling the company or absorbing it or exiting. The investor will always have liquidation priority on this. Then right of consent, obviously safe notes guys will have consent over raising further capital, merging with another company, putting more capex or anything you could negotiate. But this is just a standard list. A lock-in only applies in case an AIF or a fund is actually investing in the startup. There are information rights that the investor will have access to, obviously, and then there are these definitions. I will not really go too much in detail right now, but typically, defines the first notes, defines the SQL safe note. You always work out the share capital premium is based on the pricing of the valuation cap divided by the number of shares. So these are typical definitions, some small representations, and that's about it. Indemnity, and you just sign the document. As you can see, this is a 5-page kind of document that is there. Very simple. We've executed that multiple times and really have found no problems with that. And it's really worked. These are filed as proper documents with the ROC as well as with your company secretary. So I hope I covered the types of iSAFE by now. And so let's come to, saying, okay, fine, we've understood some of these terms. They're all there in the existing CCPS terms also. So how is iSAFE really unique? I have already tried to explain how it is unique, but again, something more about what really is happening currently in the industry right now. What are people doing out there? What's different with iSAFE? So some of the key terms, and I will probably not spend too much time because Vipul probably covered some of this earlier, and for those who did not attend Vipul's session, this is for them. So you have the whole pre-money, post-money kind of valuation, which essentially makes the company at a fixed valuation, and whatever you invest adds up to that pre-money and gives you a post-money. There's a board seat that investors demand, right? I could be getting a board seat, or I could be getting a board observer, if not a board seat. There are founder shares which get locked in, right, for a period, because we don't want founders to really get out um, before the investor. So founder shares are typically locked in. There are consent rights, as I just mentioned in the document, which will have consent from the investors prior to any material changes to the businesses, any key hires, any major capex, any changing of the business model, and stuff like that. Some more key terms are, tag-alongs and liquidity preference and drag-along, which I just mentioned. Tag-along is obviously when founders are selling, investors have a right to tag-along. So does drag-along, works reverse. If you're not giving your investor the exit, he can really find a buyer and then drag you to sell, force you to sell your shares as well, because the deal won't go through if the entire stake is not up for grabs. So that's typically the benefit of drag-along rights that investors get. A down round protection, like the way you understood in your valuation cap iSAFE scenario, where I said, if the future round happens at a lower price, you've got to give those additional shares free of cost to the investor. Anti-dilution just protects the investor to maintain his particular stake in a company. So all that happens when you have a fixed round, fixed check, percentage is fixed, and you want to retain your percentage every time. So there's an anti-dilution right where he has a choice to keep investing more and more in every round and keeps his percentage stake constant. There are voting rights that investors have, conditions of debt, stuff like that. You can't have debt, or even if you have debt, it gets frozen till investor kind of exits the startup. Information rights, right to receive MIS, financial information, stuff which I already discussed about. So how is iSAFE really different than a standard CCPS? So let's look at this table, which kind of, I'm just trying to see the time. I'm 50 minutes into the session, and I think we started 5 minutes later. So I'm good to go another 5 minutes on this. So if you really see, some of these rights really don't matter. An early stage company, valuation piece we already discussed at length. So I think that's what is most important. Board seat, you really don't need a board seat where founder is owning 80-90%. Nothing really great gets achieved by an investor getting a board seat early stage. You anyway control that with few consent rights, but you don't really need a board seat, and then get on to the company's board. That's not really required. So iSAFE don't have board seat provisions. There's no SHA here, as I said. It's a short document instead of a long one to keep it simple. Very few consent rights, right? As I said, very few consent rights as compared to a long list when you have an SHA. ESOP pool, right? You must have heard about ESOP pools. Every founder is obliged to do an ESOP pool before an investor walks in. There's no such clause in iSAFE because this is, remember, early stage. This is seed stage, where some of the key members also are not there in the company. They are still in the process of, let's say, looking for a co-founder, looking for key employee. So he's not really able to decide the pool at that stage. So hence, there's no need for an ESOP pool. And we really feel we should provide more flexibility to founders to kind of carry out their operations and not really force them with things like voting rights, founders, lock-in shares and stuff. Exit rights, yes, there are some exit rights sometimes that people negotiate, but of course, this is favorable to founders. Only transfer rights are available to kind of iSAFE note holders. Again, some very important tips I would like to share though for those who wish to proceed with iSAFE. As I said earlier, it's in the best interest of early stage founders to take seed stage investments through iSAFE, because he can then really build up his valuation by the time a pricing round is coming around. Remember, guys, equity is more expensive than debt. So when there's a big dilution that takes place, you are right there to negotiate that, because you've been well funded by angels and 100X or any seed stage fund through iSAFE, and they are ready to actually strike that decent price, and you're not really distressed to kind of just give in to investors' demand on, let's say, if I'm saying X and he doesn't have a choice, it really increases your dilution a great deal. So you will have a negotiating power now in front of an institutional investor or somebody who is trying to get you into a priced round discussion. It is also best not to do iSAFEs in tranches, because you guys may have typically heard about investment done in tranches. I would advise you to close, because of the nature of the iSAFE. Now that you know more about it, it's always best to close funding at that particular point of time with that check on an iSAFE for two parties and move on, because you don't know what the startup will achieve with whatever money is getting now, and he would not like to negotiate the same terms for the future tranche. So it is always best for founders to close it in one tranche, and so it is for the investor, because if he wants to really get in early, he should just put in one check and sign the iSAFE and just enter the company. And remember, folks, the most important, survival is the key here. If you are surviving, then you have a chance to win. If you don't get funding, if you don't even get small checks from investors through iSAFE, you're not going to survive. And that's, you're not going to achieve your dream. So it's a win-win for both founders and investors, as you can see. We really feel that given all this background and given the dynamics of it, we really feel that iSAFE is that powerful tool that can and will transform the way early stage funding takes place in India and the world. Yeah, we've been, as I said, we've been working hard on awareness of iSAFE, and there's been a little bit of coverage, and people now know a little bit about that. And I hope this masterclass really helps in creating more awareness around it. Also, last slide here, we are open for admissions of our class 2. So for those founders who are ready with their pitch decks, ready with the idea, with some proof of concept, with some use case, let it not just be an idea on paper, because ideas on paper simply don't get funded. So try to be a little bit more evolved, get something more around, market fit, get something more beyond just an idea. And then you can mail your pitch decks to, pitch@100X.VC, and we'll be happy to look at it. And, your feedback and queries are welcome. Here's my ID, Yagnesh@100X.VC. And thank you again, TiE, for giving me the opportunity to kind of address this. I'll stop here and invite any further questions. Naveen, please let me know.
Sure. So, Yagnesh, the first thing that everybody wants is if you can go back to your Excel sheet and take it a little slower this time. We need one more round of the explanation on your Excel sheet. And then, there are related questions which I'll start asking you post there.
Okay, so typically I'll focus on this and this first, because let's say there is already an iSAFE holder like 100X, or even if it's not, you could just have an iSAFE discussion, whichever iSAFE you might want to use. Have your investment done at some valuation cap or not. For example, if you are entering first, like iSAFE, I negotiated in 100X with the founder saying, I'm giving you 25 lakhs. I'm not valuing your company now. I will take 7% as and when there is a price round. And remember, folks, when we're doing this, we're taking a risk of not having a price round in future. So Naveen, you can be my devil's advocate to kind of argue with whichever side you feel. But let's say if that happens, the founder gets that comfort care. मेरे को अभी 60% नहीं देना है. I will give 7% when I am at a 20-25 crore worth company. Otherwise, 100X ka 250,000 shares just remains as it is. So that's what a benefit, a win-win that I was talking about. Coming to a valuation cap iSAFE, this is what happens, right? You invest 1.5 crores, let's say, because that's what, let's say you talk to 5 angels, everybody is willing to put 30 lakhs each. There's a 1.5 crore round happening. And by that time, you've reached somewhere, right? You're not at the beginning stage, but you've reached the place where you can say, okay, my company is at least worth 15 crores, but I'm not too sure. Let's just sign a cap. A valuation cap works based on that. So, and then I will promise you 10% stake, but not now. Again, this is again pushed to future. Right now, I'm giving you, in this example, 1,111 shares of CCPS at 13,500 rate, correct? And you get these many shares, you just keep this. And when the pricing round happens, these 1111 shares will increase to 1587 shares, folks, when you convert it into equity, thereby giving you 10% stake. So instead of just remaining 111 shares on a post money, you would have ended up with 8%. You still now end up with 10%. So when I said that, this is how your eventual cap table will look like for a 25 crore post money worth company. You as an angel will have 2.5 crores. 100x, because we came in before, earlier than you, we will still get 7%. Both don't get diluted till a priced money round happens. 10% angel gets, and it's worth 2.5 crores. He put in, let's say, 1.5 crores before the price round happened. Post price round, it is 2.5 crores. Otherwise, it would have been 2 crores. If an investor came in with 20% dilution, a 10% stake would have got diluted to 8%. 2% being the 20% of 10%. So 8% would have been of 25 crores worth company, would have just been 2 crores. Here, because it was an iSAFE, the investor benefits, and of course the founder benefits. I mean, of course he gets diluted, but he gets this money around faster. There's a quick resolution here. Money is in the bank. You can go and build it and then negotiate much higher valuation on your price round. So that's the benefit here of 50 lakhs that an angel investor can reap just because the instrument was founder as well as investor friendly. Does that make things clear, Naveen?
So Yagnesh, first question is that 7% that you're talking about, is it notional? People are asking, where do you get that 7% from?
So we get that 7% based on, let's say, early stage, right? For example, even if YC you see, Y Combinator, they invest whatever dollars they do 125,000 or 150,000 for a 7%. And they typically invest in companies at a stage where the company is not just an idea, sometimes even an idea, but sometimes not just an idea, but with some work done, some team there, some moat, some market opportunity, and a sense of getting a multiple 20x, 30x kind of return. So if that stage is there, we think a 7% is a fair stage that we are asking for that kind of risk that 100x takes.
So that's a ballpark industry.
It's a ballpark. It could be 8, it could be 6, it could be 7. I mean, no magic number. It's a lucky 7, so think of it as that. But no, really, it can be anything that an investor can negotiate with a founder.
Sure. So now, Yagnesh, I'm going to ask you a few questions
Sure.
which have come up in the past. So
I'll just kind of unmute my video.
Yeah.
Yeah. Yes.
So there was one interesting question about, founder, co-founder, diluting it at a later stage. I'm just trying to figure out where that question is.
Sure.
So what is the one question that has been again coming up throughout the whole thing is you need a valuation certificate right now. So what happens? How are you circumventing that as a company requirement?
So of course, valuation certificate is needed right now for 100x. Let's say if we are putting in 25 lakhs, we are getting shares issued at par. Remember, so there is no valuation required for shares being issued at par. Only if you are issuing it at a premium is when the valuation certificate is required. A. Secondly, just to clarify, a merchant banker certificate is not required if in case a startup is registered as a company under Startup India with DIPP. Okay. The certificate that you're talking about, valuation report, and it's a very simple thing, it's hardly any cost, is required for company law purposes where you issue shares at a premium. not at par.
Got it. Okay. So here's the question from
And these valuation reports are pretty much available. I mean, you can get it worked out through any ROC approved valuer. And if you guys have difficulty, we can help you with that as well.
Okay. So here's a question, say that there are a founder co-founder situation and that you're advising in 100X.VC and you're taking a fixed percentage at a future date. The question is, as an entrepreneur, isn't it a bad deal? Maybe if I give you a percentage at an early round, you will get it diluted at that rate. So the question is twisted around from a founder's point of view. What's your take on that?
So founders, the biggest advantage, right? I showed that on the slides, right? Why is it a founder-friendly document? You try negotiate a deal with a valuation, you will end up with, first of all, haggling for a while, not completing the transaction. Investor might just go back after doing a term sheet, not signing the SHA, or even if he signs the SHA, suppose COVID happens and you're stuck there and you don't get your money. So it is fast, high resolution fundraising document, as I said. You can close the document pretty much once you clearly agree some couple of key terms. There are not too many things you need to really agree with the investor. So the advantage here for founders is that you are getting a check. Like at 100X, I told you, right? In class 1, we really close deals in 5 days time, 7 days time, 10 days time. That's not going to happen in an SHA led round. So you either can wait, if you can afford to wait for 6 months, talk to a VC, talk to an institutional investor, a seed fund who might take time in diligence. Here, our diligence time, literally, if you have everything ready, it takes hardly 4 to 5 days. Whereas you could end up in an endless due diligence exercise and still not be able to freeze the terms with the investor in a price. That's the whole difference.
Got it. The next question is again interesting. What happens to iSAFE? How does it work during non-cash infusion from investors? When an investor comes in to use his resources and help scale up the business and
no, an iSAFE will, I would advise an iSAFE to be used only where there's an investor who is putting in money.
Okay.
A mentor advisor equity can anyway be issued without an iSAFE. So how does it really matter? Those dynamics are not there. See, valuation dynamics don't play a role in case you are my advisor and I value your services and advice so much that I'm willing to give you some equity, right? And I will take the opportunity here to kind of advise founders who typically dish out high amount of equity to advisors. That's typically very adverse or very prejudicial to the interest of the startup. And we would advise people not to do so. So let's say if it's you are my advisor and I'm giving you, let's say 1%, 1.5% to 2%, I would like to give it to you over some time. By the time I see value in your connects, you bringing in some connects to me, some investors to me, or whatever that is, it has to happen over a period of time. So it vests, it's called vesting over a period of time, and that's what typically you do. So for that, you really don't need, it all goes out from the founder's kitty. So you really don't need anything to be issued by the company, because remember, an iSAFE is a security issued by the company, not by the founders. And this mentor equity you're talking about is by the founders.
That's a very good point that you made, that vested over a period of time and not at the beginning.
Always, because, I will play the devil's advocate. I'm an advisor. You want me to just advise you on fundraising stuff? I'll be hardball and say, give me 5% or 10%. Otherwise you're not going to get investor. Don't ever get, lured by those kind of arguments, because if I'm really interested in the long-term wealth of the company and myself, I will not negotiate this hard and say, give me upfront, because that is going to discourage future investors to come in. You will be there with him for a while, but then you are not going to become $1 billion company if that's what your dream is, because you would have diluted by giving him 10% so hard without cash. And remember, after all the advice, the startup does need funds to grow. Each startup does.
So I'm moving on to the next questions. There's a set of questions from Srinivas. He's saying if fixed price valuation or next round didn't happen, the company didn't succeed, can the investor claim capital loss?
The investor can claim. Good question. And we've dealt with that. So typically what happens in our case is we negotiate that with the founder saying, fine, you tried, you didn't raise, it's okay. Things happen and shit happens all the time. let's say 3 years down the line, you didn't raise anything, which means 99 out of 100 times the startup is going to fail. In that case, you convert that to as many equity shares. Let's say if I have negotiated 7% or somebody has done a cap translating to a 10%, give me that many equity shares. It gets converted at a particular time when both companies agree, company and the investor, and you just try to sell it for a $1 or a 1 rupee and just book your capital loss. And that's the only resolution. At least you get your tax related loss and claim it against other gains in your portfolio.
Got it. Can iSAFE be done after first round with normal SHA?
iSAFE and SHA both will not coexist, right? iSAFE always precedes SHA because the minute SHA happens, आपका cap table final हो गया, right? Your cap table is frozen.
There's a no hybrid model that has come still.
No, this is the hybrid as best as it gets.
Okay. Okay, then there's a question that maybe can we get a contact of a CA legal person who does this? Vipul Mehta does it most of the time.
Vipul Mehta does. He also has done a couple of iSAFE rounds with us, with our investing companies. So please feel free to go to him. Or if you want us also, we can refer to people. So no,
question from Shanmuga Raja next, which is asking on how many have you invested through iSAFE in your portfolio?
So we did class 1, 20 companies. We are already looking at further more companies in class 2. So yeah, all of them through iSAFE. And half of the companies got funded through us, also raised subsequent money through iSAFE.
So you converted and monetized basically.
Yes, and so no, we have not yet monetized. We have not yet converted. Our stake is also continuing, and the angel investor invested through iSAFE. So both iSAFEs are coexisting at this point. But right now, it's just a year down. We've invested, so it's too early for us to exit. I mean, we are looking at a multiple X return. Remember.
Okay. So the same question is a continuation. Is that do you foresee any challenges with VCs or institutional investors in the future rounds?
No, absolutely not. In fact, I don't want to name one of our companies, but one of them may be looking at closing a VC round, and they have studied iSAFE, and it's perfectly okay with their legal team.
Excellent. Next set of questions from Jayesh. MNF clause, is this till termination of iSAFE, that is both, and conversion occurs? Or does the MNF status carry forward into the future round also?
No, the MFN will expire the minute there's an SHA, right? Because the SHA will override anything, an iSAFE, an MFN-led iSAFE or whatever. The minute there's an SHA in place, everything else just goes away, and SHA will prevail.
How does iSAFE be applicable for investments raised from abroad? Have you seen those kind of deals which have come from?
Yes, so we are looking at a couple of deals happening through iSAFE, and this happens perfectly the same way as it happens within a domestic investor. So there's no difference between a US investor and a domestic investor, except that if there's a foreign investor investing foreign national, the company, your startup will have to just do some RBI related, it's called FCGPR filings, which you have to do after the money is received and the shares are allotted. It is just a compliance measure by the RBI because you're inviting foreign exchange funds. It's a filing that you have to do with FCGPR, which I'm sure your consultant or your CS will definitely know how to do.
Good. You answered the next question also, which is what it was leading to. Interesting question. How do you explain down round protection in iSAFE?
Yeah, so I gave an example, right, in the valuation cap slide that let's say I invest 2 crores in a company with a 20 crore cap. I'm eligible for a 10% whenever the price round happens. For some reason, the company went downhill after my investment. And now the only valuation cap that they can get or an SHA is at 10 crores. Now that's a down round for me as an investor. And I should logically get compensated for the loss in valuation. So if it's 10 crores, I get double the shares and I still keep 20% in the company as against 10%.
Okay. Interesting. One more question. So there's a example of a company which Y Combinator invested in called as TopTal. The investors were TopTal, and the question is that you cannot really force a conversion with founders. So is that a problem with iSAFE from a VC's perspective?
No, I think the contract is pretty clear. The way we have, we spent a lot of time and money with our lawyers, believe me. It stands the test of law in India. The conversion is promised by the founders via a contract, and it's a legally enforceable contract. So as iSAFE investors, you can go to court if your shares don't get converted.
Got it. And is there tax implication on iSAFE?
No, there is none, because the conversion will basically happen. You will continue to own the security. The amount of investment remains the same. It's only when you sell the converted shares, as per Indian laws, is when you actually attract capital gain.
Okay. I think this question you might have answered, but again, I'm re-asking it. Please clarify if CCPS are going to be issued along with iSAFE.
So iSAFE is CCPS in legal form. iSAFE is actually just a branding so far as, because just to distinguish it with a CCPS with fixed valuation. So it's still CCPS. So legally, it was there in one of the slides. So it's still compulsory convertible preference shares. So it will not remain as preference shares. It will have to be compulsorily converted into either an equity shares or a Series 2 CCPS. So let's say mine is Series 1 CCPS. The next investor who is valuing the company also, but remember, they will get CCPS. So it becomes a Series 2 CCPS, and the Series 1 just goes away.
So is it safe to say iSAFE is a subset of CCPS?
iSAFE is just branding. iSAFE is I'm calling my CCPS as iSAFE, to keep it really very simple for some.
As opposed to photocopy and Xerox.
Exactly.
Perfect. Got it. Okay. That was really useful, that example. Which sectors iSAFE platforms are useful in a post-COVID situation?
iSAFE is sector agnostic. It is the form that tells you to raise capital with less friction, with less amount of, with the fastest speed. So, right now it could be really useful because, people really don't know, including investors, mind well, what's going to happen after COVID, after normalcy returns. Some startup that you can see something which somebody else can't see, you really enter that fast enough with an iSAFE, and don't take too much time, because the more time you take, remember, more number of people are going to discover that startup. So you could really close deals pretty fast, right?
Here's a question on the cohorts, the next one, which is basically asking, are all companies going to be evaluated the same way? How is the funding amount determined, and what is the percentage? Like, the famous 7%. Are they all going to vary? How is it going to happen?
So currently it's been 7% for us, because we only take companies. So for example, somebody reaches a 10 crore revenue and he's at a different orbit or a different milestone lifestyle stage. We will not enter those companies. Our thesis itself is, that could be a very good pre-series A or a series A led company, where that guy should really talk to a VC fund or a larger series A, series B company. Our kind of companies, as I said, we are a discovery platform. 100X discovers startups right from, it's like from the rubble. We really pull out those diamonds and moonshots that actually are capable of giving 20x or better returns in future. So our hypothesis itself is to look at companies which are bootstrapped. They are the ones who are undergoing maximum pain right now. And that's what our system needs. Our system doesn't need, for a slightly successful company, there are multiple investors lining up and queuing up. You've seen example, right? Let me not say, Beju's did multiple rounds in 1 year itself. So once somebody's successful, everyone wants to chase that, right? But there's hardly any people who are willing to take that challenge of going around, pulling up your sleeves, really going after those companies and finding out those gems from that, too many companies out, and see whether they can really get funding and have a chance of survival. So a 25 lakh check or a 50 lakh check from 100X can actually make a difference in the life of the startup.
And you're sticking to the same investment range?
Yes, absolutely.
So I think that was the question which Teja.
Yeah, so guys, if you're really expecting $500,000, you need to go elsewhere. But remember, for that guy also, let me say, and we've done this in our last class, very interesting, Naveen, I'll share with you some data points. We had some startups, typically, everybody's deck says I need $500,000, because that's minimum I will take to kind of build something meaningful. And we sat down, and ultimately at the end of the discussion, he said, when can I get 100x money? Because what we did was we said, look, with 25 lakhs, you will reach from A to B. And from B is where everyone will start chasing you, because we will do the pitch day. We will showcase this to 100 odd investors we are a discovery platform. We work with all VCs. We work with all angel platforms. We work with everybody, family offices, HNIs. So, I mean, the kind of discovery we can do and make you stand in front of those, you can never do it alone. And he got the point. He signed up in class 1, and he's one of the best companies within our class 1 portfolio.
And people have invested further in him.
And the second round closed already.
Oh, excellent. There have been a few questions which, interestingly, the audience themselves have answered it, so I'm not going to pick up that. Thanks, Jigar, for giving the answer there. How valuation cap and dilution are determined for future pricing rounds? How do you start off with that?
I mean, that's I don't know if Vipul covered it. It is my favorite line that, valuation is an art in the early stage and a science later. It becomes maths later, but it's very much chemistry and physics, chemistry between founders and investors. And the law of attraction happens between the two. So it's mostly a science, an art, early stage. So, the cap could be anything. The cap, typically we've seen 100x companies getting valued post 100x investment at a cap of anything between a 10 to 20 crore kind of amount. So I don't know, it's a wide range, but it still gives you some sense of what these companies post 100x can get valuations for their pre-series A.
Okay. Thanks to Hyderabad Angels for answering a few of my questions. That's also saving us time.
Well, thanks to all of you guys who are able to, at least decipher for others.
No, in the Q&A, it helps if among entrepreneurs and founders, they do a lot of brainstorming.
A lot of brainstorming. Absolutely.
What are the expectations from founders while approving investments through iSAFE?
I mean, absolutely none. I mean, it's just a process. We normally do the entire evaluation just like any other seed stage fund does. It's just that our process is way faster. We tend to take bets after doing all the homework, but our turnaround time is pretty fast. And once it's agreed, we issue the term sheet. In the term sheet looks very much similar to the iSAFE guys. Mm-hmm. So if you've seen the term sheet and signed it, there's no surprise in the iSAFE agreement. It is ditto, same to same. So once you sign the term sheet, we go deeper, just ask some of your company documents to just make sure, do some diligence, some ref check of founders, and then we are ready to fund it.
I think, Yagnesh, looking at the questions that are coming about, my request or my suggestion is that, get 5 or 7 of your founders to do a brainstorming chat, record it, and put it out on YouTube.
Absolutely. All about it. Good suggestion.
Yeah,
good suggestion.
I think a lot of the
some of the founders some of our founder audience here, I would request that if you are interested, please write to me. My email is Yagnesh@100X.VC. I will put you in touch with the founders who are from class 1 and who can actually tell you from your perspective. I'm an investor, so I might miss out a few things while talking, but a founder's predicament is only understood by another founder. So I would quickly put you in touch with at least 4 or 5, not just 1 or 2, and you can keep doing calls with them and go ahead and take a decision which is best suited for your company.
Yeah, I think that's what I was getting to also, Yagnesh.
Sure. Happy to make introductions to our class 1 guys.
There's nothing better than a founder.
Absolutely.
Sorting another.
Absolutely. I'll wait for you guys to forward me, or my email is there, whichever way.
Can an individual also use iSAFE to invest into a company?
Yes, absolutely. And some of our angel investors are individuals who are investing into startups as individual investors. So and believe me, those are the ones in COVID times. Just wanted to share here, very relevant point. 4 or 5 of our deals got converted, got funding through iSAFE from angel investors during COVID time. So we were pleasantly surprised to see angel investors working with far more speed than some of the more organized, institutional VCs or family offices.
The next question is, valuation certificate required at the time of conversion of CCPs to equity.
Yes, I mean that in any case you will, right? Because when you're doing an SHA, your company is anyway getting valued. Let's say in our example, a 25 crore valuation, you will obviously need a valuation certificate uh, for that process itself, and that same valuation certificate will hold good for even this conversion.
Okay. How easy or difficult is it to get a DIPP certificate? What's the
Very
experience?
easy. 3 days time, 3 to 4 days. I don't know. Maybe COVID times you might get it in 7, 8 days, but you just have to file details online and you get the certificate online. So there's nothing else you can do better than that. I mean, there's no physical interaction. There are no delays there. We've seen startups getting registered in DIPP in a flat 7 days time. And I would also request here to also get them registered under section. There's a section in income tax. I forget the section. It's I think 87 or something, where after getting registered with DIPP, if you file that with income tax, you are eligible for those income tax exemptions, the angel tax exemptions that are there. And I mean, it's just a precaution, but all as a good measure, I think all startups should also register with income tax after they get their DIPP, just to ensure that you are exempted from angel tax.
No, I think DIPP registration is a must. There's no
Yes.
way today a government is going to recognize you as a startup.
Absolutely. And nowadays, no investor will touch you even if you're not DIPP. They'll tell you, oh, please go and register yourself with DIPP before we invest.
Yeah. On a
I think it's a
sorry. On a side note, take a look at our YouTube session with Sanjay Mehta, where he interestingly mentioned that also go get a SME license.
MSME license. That's right.
That will take you about 4 to 6 weeks, but you're going to get protected much more over there. And we are
There are benefits of there are benefits of getting a lot of tax rebates. There are also recovery periods that you can enforce on your debtor, on your receivables. There are various. I mean, you should really go and spend some time on that MSME site where the benefits are listed. It's some of them are very important. It's not just a list of things that you don't care about.
Thanks. You've actually answered a couple of the questions about tax break. People have commented that's difficult to get and stuff like that. But yeah, I think.
Yeah, no longer. I think these things existed a couple of years back, but now government is very clear. They want really startups to actually grow, and the no more. You don't expect I'm taking a 2 crore check in my startup. You're not going to get income tax notices now. There's no way. I mean, you are exempted through angel tax, and if you're registered with DIPP, there's no way there's any tax impact to anybody, neither the investor nor the startup.
So, Tarun, I think the answer to your question is it's more 4 weeks, not 4 months in iSAFE.
Yes.
Like Yagnesh has said, they've done iSAFEs in 3 days.
If you are ready, it's lesser than a week, folks. I mean, I can guarantee you this.
And Shilpa, to your question of will 100X give multiple iSAFEs? I think the answer came about a little earlier where he said try and do it once, not multiple times. Then, can iSAFE be used to receive money from family members?
Of course. Why not?
It's just an instrument like any.
It's just an instrument. You use it with anyone. In fact, I would strongly advise to have any investment, either through family or friends, buy through an iSAFE or some document. I mean, I'm not really saying this here just because we are proposing to do iSAFE, but have some document, even founders. You're inviting a new co-founder, and if you really want him to really get that 10-15% stake, get some amount coming, because that's skin in the game preferably. And if he doesn't have money, at least sign a founders agreement and get a contract done, and then give him that stake. I've seen founders being rash enough to just issue equity shares and without any paperwork, without any founders agreement, which becomes, and remember, if they have a fight later on and a disagreement, you're going to end up in all kinds of mess. So you don't want to do that.
And over here again, I think some of the experienced founders would tell you that vesting is again not a bad idea when you're bringing in a new co-founder.
Of course, I would strongly advise if we've done founder dating, Naveen, you know this, right? We've done founder dating once, sessions, and
again on Zoom now.
Yeah, so founders dating, we are going to renew that again and do a couple of more in the coming weeks. But yeah, we've seen you're there with your company, right? Every company doesn't get started by a team of co-founders. There is one founder, brilliant idea, great guy. He can sell, he can get funds, but he needs a techie. So he goes out and looks for a techie. A tech co-founder, or for that matter, a BD founder. When you're talking to a stranger, you're trying to get connections done, you're trying to make your connection. You need to be very comfortable with him on paper, because something goes wrong. He also needs to, he's giving up everything and joining your startup. Even he needs to have something on paper just to make sure that he looks, the company has looked after him. So always, do a co-founder agreement, and there are, enough agreement types available. So I would insist and really recommend founders to don't have have a founders agreement. Get it done in whatever shape you want to keep or writing it, and discuss ESOP pools within that, which founder contributes how much to ESOP pool, things like those come into those founder agreements.
This is an interesting question again, Yagnesh, more towards investors. How do you folks manage due diligence at an early stage or for early rounds?
Well, not much, because there's no history, right? You would have incorporated like 5 months back or 4 months back. I can't go back. The only thing that I can go back is if you have done another company before, we might want some details of that company. And if there's no history, it's fine. We do diligence, we do ref checks of founders. There's not too much. We are going to be the first check. So for whatever money that has come into the startup, we would need some details of whatever infusion has come from either family, friends, or founders themselves. I think that's the only thing we need to see. There's not too much diligence because there's no history out there to see.
I think, Prasad, your question of what happens if a startup fails, Yagnesh has just answered it. And thanks to a lot of people again who have been answering stuff. Again, tax
Yeah, so just one point here, Naveen. Let's say if the startup fails, there is no obligation of the founder or the startup to repay the iSAFE amount. Please note this. It will get to zero. You will have to write it off, or maybe sell it at a 1 rupee to make sure you get those tax capital losses for your other gains. But there is no liability of the company or the founder to repay this amount at any point in the future.
Got it. So there's a question about your example of on the Excel sheet where you said at 2.5 lakhs you've issued some shares, and I think the point that Jigar is trying to make is will you become the largest shareholder at that stage?
I know, right? Because we are going to always be a small investor because our check size is small. When your multiple rounds happen later, the later ones will always be higher checks, and they will always take the larger pie of the cake.
Okay.
Like you saw, right? The VC came in with 5 crores and he took 20%. So that's always going to be higher than any other previous angel investor or 100X for that matter.
Are you compliant with RBI, FEMA regulations? I think you answered that also.
The FEMA and the RBI doesn't apply here. The only law that applies here is company law.
Okay. Again, I think you've answered this. What happens to Series 1 iSAFE when Series 2 iSAFE comes in?
Yes, so Series 1 converts into Series 2. Your capital, your bench of capital of Series 1 gets vacated in favor of Series 2. So your Series 1 will convert into Series 2. And the final cap table will have all founders' equity and Series 2 CCPS at the end.
And what are the scenarios of an iSAFE exit?
So iSAFE can be transferred, right? With due permissions, right? Let's say founder doesn't mind. I'm an investor. I have found my cousin who wants to buy these shares of preference shares. With assigning the same rights, it can be done, but with the prior permission of the founders and the company. Because as per company law, private company shares are not freely transferable. And more so, if the agreement is to kind of hold on long term, then, and even if there is some situation exists at investor, they could easily approach the company and say, look, because the founders are very careful and should be careful about what set of investors is entering their cap table, even in the future. So there is a permission required or consent required for the investor to take before they wish to sell their stake of iSAFE or CCPS to somebody else.
Got it. how can HNI invest in funds where iSAFE invests?
So ideally, my answer would have been invest in 100x, but currently we are not really raising capital. We already have enough capital to invest in startups. But yeah, typically a fund, a category AIF category 1 fund which invests in startups is a fund you go and invest into. And there are quite a few seed stage funds which are inviting LPs. But obviously you should ideally you should have some history of investing. You should be an angel investor. You should know how this works. Only then probably some seed stage fund would probably want you to become their LP.
Got it. I think, Tarun, the point being that iSAFE is just an instrument. So whether it comes through individuals or through fund, I think that doesn't change
The only fund right now that uses iSAFE is 100x. There is no other fund that I'm aware about who has still started using iSAFE. Maybe there'll be more coming in later, but right now it's only 100x which uses iSAFE as an instrument.
It's an interesting question, little quirky. What happens if a startup does a superb job and doesn't need a VC round in the future? How does iSAFE?
So in our iSAFE, there's a clause saying 3 saal mein, 3 saal mein to convert karna padega na. So you do a brilliant job, you give me my 7% at the end of 3 years, or give that 10% to that angel investor at the end of 3 years.
Excellent.
I mean, if that startup really doesn't need money, then I'm a little worried, because to what extent the valuation will go without accepting funds is a big question. So those founders need to think about that.
So there's a question from Shabnam asking that how do you guys evaluate a startup that needs money to do R&D in a promising tech?
Depends on what that amount is. See, listen, what happens is if it's a long cycle of R&D, we typically tend to avoid, because what happens is if you come and tell me as a founder, sir, मेरे को 10-12 महीना लगेगा R&D करने के लिए. Typically, I am expecting you will need at least $500,000 to kind of do that R&D if it's that big a thing. If it's a small thing, you could just pivot, do an R&D, convert everything, be done with in the next 2-3 months. We are open to look at it. But then if it's going to take longer, the more uncertainty comes into the picture, right? And that's what you don't want as an investor. And that's more risk for us. We might want to take it, but that's more risk for the investor.
And also, Shabnam, what would have helped is to explain what kind of R&D it is. If it's a medtech, pharma, then I don't think.
Yeah, and we believe, Naveen, you know this, right? No, if you're building something, build it fast is the key. Put it out there for the customers to use it, start getting feedback, start getting organic traction, fee, everything. And then you would have much more belief from investors than otherwise.
And if you're doing pharma R&D and medtech R&D, I think grants is the only way that you're going to.
Grants is the only way. There are enough and more, associations giving out grants, state governments giving out grants. And you could use that to reach a stage. And then probably when you're ready, come to somebody like 100x or a seed stage fund to kind of make you a discovery platform kind of eligible candidate.
Yeah. So I think, Yagnesh, that's about it. Some of the questions are there which are fairly sector specific, which we have always covered up in all the sessions. I know you are paused for time a little. So
no, I'm happy to kind of take a couple of more if there are really ones. Otherwise, they can always send it to me by email, and happy to answer that. And
what I'm really happy about today's session, Yagnesh, is a lot of the sidebar discussions on the chat are more discussions rather than questions to you. People have been answering and explaining it to themselves as the group. So which kind of also helps us a lot.
Yeah, so Naveen, we also kind of, I've been doing a lot of fundraising webinars as well, but that's a point for later. Right now, this discussion was purely to remove myths around iSAFE and the clear benefits, advantages, dynamics of iSAFE. I hope that was achieved today.
Yeah. So one sector which Shilpa wants to know is, what are you guys, do you look at Ayurveda and yoga?
Yes, it comes under wellness and healthcare, and we are definitely looking at it. We feel, but given the right business model, these businesses can really have business model challenges. So we would look at something which has a brilliant business model.
I think the delivery mechanism, Shilpa, on what platform you do it, how you do it, it
Yeah,
was the key.
because remember Indians. I hate to say this, but Indians love to go on YouTube, try something free which is available, and try implementing that. May not be good, may be good, but that's how the Indian culture is. So for that culture to change and adopt to something which is online, follows a regime, or do some kind of payments structure around it and make it subscription based, if something interesting can come up in that model, is what we would be keen to do.
There's one more technical question, I think, which you can explain from Shomik. Is in your example, when the VC comes with a check of 5 crore, but a condition issuance of CCD, will it impact the conversion of iSAFE?
Typically, it will not, because a CCD is not a price round. I would think it will not be, because for a iSafe to convert, the condition is very clear. It has to be a priced round. And a CCD will have a future conversion date again. A CCD also has, let's say, a 3-year window at the end of which the debt will convert into equity. That's possibly the time when even iSafe will convert.
Okay.
Which probably may not be a good idea for a founder, but depends on the situation and circumstances completely.
And what happens to cases, Yagnesh, where again there's a question there where founders are having loans and debts? How do you then look at iSafe for them?
So iSafe doesn't really depend on the situation of the loan on the balance sheet, because this goes and sits right on the shareholders' funds. But yeah, generally answering this, we hate to have debt on the books unless it's from the founder, and the founder clearly undertakes to kind of keep it on the books, not until the investor exits, and which every investor will. So typically what ideally happens is, if it's not too much hassle, just convert the debt into equity, just capitalize your balance sheet better so it looks better. Otherwise, if there's a repayment obligation that a founder has, that will have to wait till a particular stage where there's enough cash generated from operations, remember, not from investors' funds, that will allow the founder to take back the money of the loan and then repay it wherever he has taken it from.
Okay, Yagnesh, thanks a lot. I think we've more or less covered all the questions. Folks, if you've got any more questions, please write to Yagnesh directly. He's the expert. He's the man who has actually architected whole iSafe notes in India for the first time. So thanks a ton, Yagnesh. This is going to really pave the way for the future of investing in India at an early stage. It's making it easier for all of us. So thanks a ton. And let's look at a future session with some of your interesting founders who can come and share their experience, not necessarily about 100X.VC, but also about how they've grown, because you guys have basically stellar founders who are growing at 100X right now within the last 4-5 months since the investment.
Yes.
So folks, again, minimum maximum again has been explained. It's 25 lakhs to a crore is what 100X.VC is doing, and they're open for their class 2 right now. So
and the email ID is pitch@100x.vc. So please mail your pitch decks if you're ready. If you don't feel ready, please don't. You might not get a positive response. So we don't want to really disappoint founders unless you've done a thorough job of your pitch deck, covered every aspect. Please don't mail it to us. Otherwise, it's going to be a waste of your time, our time.
Sure. And keep looking out for the next few webinars of TiE Mumbai. There are again, they've always been interesting. There are some more interesting ones. The challenge that we have is to constantly keep innovating and getting good experts, which we will promise to deliver. So see you all guys tomorrow, day after. And there's a demo day happening on Sunday for the retail folks, and where 100X is also participating as investors in that. Thank you all. See you soon. Take care. Be safe. And keep the optimism. Keep smiling always. Bye-bye.